Today I'll take you through how you should be thinking about in terms of strategies and how a strategy is formed and what goes into creating a strategy from a quantitative perspective. So as my pick shows, yes, I like try to give you some kind of paradigm. Maybe it is shift for few or maybe it not, but yes, I'll try to give you the perspective of how any strategy works and how the strategy should be analyzed when we are looking at from the quantitative perspective. Okay, so before we begin, let's have some housekeeping stuff to be done. That's a headset requirement. I hope everybody would be listening to us clearly and they would be having their connections and all things ready. And secondly, the question and answer session will happen at the end of the webinar. So please keep your questions ready, and then you can shoot at me once we are done with the webinar and all the stuff. And regarding the web recordings for our webinar, the webinar recording will be mailed to you in some 3-4 days. So we'll just try to make it more proper for you, and you will also have the presentation which will be just working with you guys. Okay, so let's begin. So to begin with, I like to present you some hard truth. So I thought, let me give you first the shockers when we start with our presentation, that what you are going to enter into is some place where it requires hard work, real hard work, and you might get a tip here and there that, okay, you can go and buy XYZ stock because something is happening, but that kind of profits are not really consistent. You really need to do some hard work, and for the consistent work, you need to have good methodology, and through quantitative trading strategies, we try to establish some of the proven methods which can give you consistent profit. So that's our idea. So you can ask me, okay, you are talking about the trading strategy formulation. So what all you require? I say we require few steps. These few steps go about in any kind of a strategy formulation. Basically, we are talking about in the quantitative trading strategies out here. So we take you through the various process. The first starts with the hypothesis formulation. What is a hypothesis? You form a hypothesis that, okay, the market behaves in particular fashion. I like to do something like, I like to do a trend following or something like that, which we will be discussing in a short while. Then we have something like call. Once you have decided upon your hypothesis, you try and formulate all those codes in, say, in any testing softwares like R or Excel, through which you can check whether your hypothesis have really worked well in the past, and you try to optimize the parameters to see which parameter worked well in the history and which is you think can perform better in the future going forward. So we calculate the backtesting and optimization. The third process goes into coding the strategy into the trading platform, where you have your hypothesis being backtested, proven, then you have your algos, you write your code such that you try to execute it through the trading platform, and you try to arrive at a better execution using any algo trading platform. So once that is done, you move on to the simulator testing. A simulator testing is a process where you try and send order not to the exchange but to the simulator environment, which will be looking like an exchange, but your orders will not get actually executed at exchange, but there will be a dummy kind of a exchange, and which will help you to test the functionality of your algo system. Once you have done the testing of your algo trading system, your functionality, then we move towards something called the trading in live market, and there you go. You have the full market and the full scenario for you to just go and take on the market. That is the 5-stage process that we normally go. In today's webinar, what I'll try to give you the idea about the hypothesis formulation, what kind of hypothesis formulation you can do, and then we spend considerable time on the back testing and how, when you have a back tested result, how would you like to have a comprehensive view about the feasibility of the strategy. So that's how we're going to proceed for today's lecture. Okay, coming back to the first point, that is hypothesis, designing a trading strategy. As I always believe that market has place for everyone. It is up to us to choose a game. So choose your game. What game you would like to play? So the question can come to you, okay, I would like to play a trend following. So you might have heard various traders who have worked across industry, across geographies, across asset classes, who have made good amount of money in the trend following. So you can also choose that, yes, I would like to have some system which will be a trend following system, and whenever the market trends, I like to deploy that system, and your system will make money. So you follow a trend following system. A trend following system could be very well like something based on the moving averages, if I talk about the technical, or it would be something like based upon the say crossover of the moving averages, or you might have some other technical indicators, like you try to find out some kind of a trend in the market and then you play with it. Then this is and then trend following give you certain amount of risk and the rewards are higher. Arbitraging, you can choose to do an arbitraging, and arbitraging would be nothing but you try to find out what is the difference between the prices of a same security being traded at say two different exchanges. It might be traded at two different geographies, something like a stock being traded in US and Europe. You try to see, oh my god, there's a difference in the prices, let me go and harness it. So you can also have some kind of arbitraging method in say, oh, I see the options in Nifty are not very well priced compared to the other options in Nifty, or say vis-a-vis future. Then you try and trade such way that you really get the difference between out, and these kind of strategies are usually termed as low risk and low return, because you do not have these arbitrages are pure arbitrages, and these ones says that okay, they will come back, you will not lose money. It's just that there is a temporal mispricing in a same instrument in a two different exchange, or a two instrument of a same underlying, because of the market trading. And here the algorithmic trading plays a very crucial role. Moving on, we have, or you can choose a third type of strategy that we call mean reversion. A mean reversion would be something like statistical arbitrage that we call a pair trade. So you look at say the pair trade between Infosys and TCS based on your tools, like we talk about tools like co-integration, which gives you idea, okay, that these two pairs are co-integrated and they do have a tendency to revert back. So if Infosys moves quite away from the TCS, then probably you can have a statistical evidences where you can go and trade and make money out of these two stocks. You go long on Infi or you go short on TCS, and vis-a-vis you create a strategy. Third is a market making strategy. Let me give you some idea about what's a market making strategy. A market making strategy is nothing but a condition where a trader tries to be on the bid and the ask side of the market. Suppose I am trading in the Nifty futures. So a market maker would have the idea of trying to stand at bid and ask, say B dash and A dash, so that he would be like that someone would come and sell him at A dash and he get bought at B dash. So what will happen is bought at B dash. So what will happen is I am able to sell at A dash and being bought at B dash, my net position is 0, but I would have pocketed in the difference in pocket. So this is something where I always try and keep standing on the bid and ask side, such that the difference I do get pocketed, and my idea would always be that A dash minus B dash is always greater than my transaction cost, so that I really make some profits. So that is the idea of a market maker who would like to stand in the market at various points and try to make the difference. The other market maker would be someone who is being designated by the exchange, and the designated market maker would be having the obligations where he would be required to manage a particular spread. So he would have A dash minus B dash is equal to say S, which is being obligated by him by the exchange for the return of some kind of incentive. So that's how any market maker works. And that is how a market making strategy is. So it's usually not being done, it is being done from the basic use of your HFT, where you look at the data which is coming to you with a very high frequency, and you keep on analyzing it, and you keep placing your bid and ask, such that in always condition your position is close to zero and you really make money out of it. So these could be some broad categorization and thought where you can look for these strategy. Your strategy, whatever kind of strategy you might look at, okay, an option strategy. An option would fall somewhere like and arbitraging, where you see that, okay, there's a difference in the option price, I'll do it. Or you take naked options, then you can say, oh, it's more of a trend following strategy and something like that. So these are the broad categorization I thought that I should lay before you, and the various kind of strategies can be put under these various broad categorizations. Okay, so now you can formulate your hypothesis in one of these areas.
Welcome to GoToWebinar, web events made easy.
Says that a stop loss is a point where you feel like, oh, I cannot lose more than X amount of money in the particular strategy, so I should take a stop loss. Well, we do not look a stop loss in this fashion. For us, a stop loss is a condition where your hypothesis have failed. So once your hypothesis has failed, but your trading signal has not generated a signal to cut your position, then we say it is better to take a stop loss, because hypothesis have failed, and that because hypothesis have failed, you should get out of your position even if your trading signal in opposite direction has not been generated. So that is how we define the stop loss. When we go into the EPAT course, we discuss about various stop loss conditions in a trending series or in a mean reverting series, where we can show you that a hypothesis have failed, still the trading signals will appear that it should be buy or it should be sell. So, but it is very wise to cut out your position, and it gives you a tremendous amount of boost in your profits. So that's how we believe in designing the stop loss, not just based upon the amount of money you can lose, but it also a function of your hypothesis. And that's why it plays a very important role. I always stress on the how you define your hypothesis, and that's a long time being spent in a EPAT course while we discuss about the hypothesis formulation. Okay, now profit taking. Now you have to look at profit taking similarly as we said, that stop loss, that my hypothesis is valid. Now I don't see much of the movement from that place, since hypothesis says that beyond this point there won't be much movement, so you cut your positions. So you have to define your stop losses and profit taking again from the perspective of your hypothesis. Sufficient sample trades. Yeah, I have seen many people when I have been interacting with lots of traders, and I have found out that they'll come to me and say, okay, I have done the back testing and see these are the results of 20, 30, 40 trades, and they say that, oh, my system seems to work well now. Should I go ahead and test in the market? I always say strictly no. I need at least 100 plus trades to see whether your system is right or not. At least you need to have other criteria also, which I will discuss, but at least in terms of simple number, I need at least 100 trades. That gives me some confidence. And finally, statistics helps to formulate your hypothesis. So you can ask me, oh, you have shown me trend following, arbitraging, mean reversion. Okay, so much. What is the basic tool to do that? So my basic tool is statistics. The statistics gives you how the market looks like. It can give you the idea about, oh, this thing looks like this, so I should try this. So let's move ahead now. Okay, now the hypothesis is formed. So what? So once your hypothesis is formed, you need to check the past performance for the designed hypothesis. You say market is going to trend fine it's going to trend and I am going to buy at this position. But fine, why should I agree upon your point? So you need to show me some kind of results. Result performance stats should back your hypothesis. You should say okay, these times my hypothesis will work and these will be the returns. We'll take up a sample example regarding this and then you will be able to more appreciate on these points. And why you need it. Investor needs to be shown numbers to validate the substance in the analysis. I'm an investor. I will say, okay, I agree that it's good that you feel that market will trend or the market will mean revert, or you can be a good market maker. But what makes me believe in your numbers? So you say that okay, these is the numbers which have been done in this fashion. You will be subjected to through the scientific rigor. You can do whatever and you can see that yes, the results are fine, and these past performance will give you some kind of an idea about how the strategy is going to perform in the future. And that's how you should approach things. Hence, backtesting is important. Backtesting is a process by which a trader subjects the market to the designed rules to check the performance in the past. Process in backtesting. You choose a detailed historical data with the following characteristics. Sufficient data number of data points so as to create sufficient sample of trades. At least 100 plus trades have to be generated to see whether yes, my hypothesis hold true, and at least it gives you some confidence about your trading system. So it should be in sufficient details with the various market scenario being handled. Some scenarios like bullish, bearish. So what are these? Let me give you an idea about the various market scenario. A market scenario, a market can look like this. Okay. So here we will have, say, I call it this phase as a consolidation, then bullish, then bearish. Sorry, not bearish. This is a distribution. I'll just explain to you what is happening in each of one of them. Bearish and consolidation again. So let's start from here. What happens that there is some kind of new inventions, new technologies, or new kind of policies which affect some kind of a bullishness in the market. You can look at new inventions, something like your IT boom. When IT came, the internet and so many websites came, so market took up a bullish move and just started keeping moving up. Or it could be a policy action like from 2000 to 2004, many FIIs started investing in India. They find it out to be a very lucrative, and the money bringing in India became very easy. So many FIIs started moving into India. So we have a bullish phase where because of some kind of policy change, you have a market moving up. But once the market have moved up, it has to come into some kind of stabilizing factor. So what happens, the stabilization factor is that money starts moving from the sectors, the stocks which have really performed well, and that then start moving into the stocks which have not really performed well. So this is the way the money starts churning. Not new money does not come into the picture. Money flows slightly less, and you will have some kind of a tapering. You might not have this just a flat plateau. You might also have something like this kind of a phase. Then after the distribution, the euphoria has just subsided and people start feeling, oh my God, I am just paying too much for this amount of stock, so let me go and short. So during that point, you attain a bearish kind of phase. Again, being triggered by some kind of a policy or some kind of a feeling that okay, that this is not going to sustain, and people just start cashing it out. And when people start cashing it out without any buyers, you have sudden fall. That is we call bearish. And then after the market have gone down, you find that there are few takers who are always on the sidelines who say that okay, now the prices have corrected to a certain level, let me come into the market and start buying. So that is a phase where you start have some buying, the consolidation. So you have basically three phases. that do come into the market: bullish, distribution, bearish, and consolidation. So what you really get out of it is a different scenarios. Now, for me to say that this is very easy after in the hindsight, that this movement is bearish, this movement is bearish, bullish, and consolidation. Then, but if I have to look all these things in terms of how will they in future, it's very difficult. But when you are deciding upon your data points in terms of choosing out, so you should have a phase where is a bullish phase in the market, distributive phase in the market, bearish and consolidative phase, to really take the full gamut of the market picture. Make sure the provision for the brokerage and slippage cost has been made into your system while you are trying to do the back testing. And last, beware of overfitting. What people might do is they say that, okay, let me try out some kind of juggling. A juggling could be something like, we will be taking an example of, say, moving average. So you say that, okay, 10 moving average is not working well. Let me try out with 12, 13, 14. Oh, 14th moving average is working very well. Let me use it, because the results for the past say 10 years have been wonderful, so let me use it and I hope this will work well. So that is a case of overfitting. You should be very beware of that your system does not overfit the data. How you remove it? I'll just give you an example. Say, suppose a trading strategy deploys end-day moving average for the signal generation. Now the question trader faces, what should be the value of N? As I was just talking about, select. Let's take a sample hypothesis which we will be using in the later half of this lecture, is that if my market or my daily prices closes over, say, end days moving average, then I will buy, and if my market price close below end day moving average, then I will sell. A very simple hypothesis. I do not know how it works, how it do not work. I'm just taking, maybe this is give me some kind of idea of the trend, but I'll discuss it later. But suppose this is my basic hypothesis. You say, okay, N, what should be the value of N? It could be 10, 20, 30, 40. How? But how will I know it? And you say that where we can have been problem for something called overfitting. So how we avoid it? So how we avoid it is very easy. Divide the data into two parts. Say A and B, 80%, 20%. Suppose you have 1000 data points. You have 1000 data points, 0 to 1000. Divide it into 0 to 100 and later 200 over the time period. Apply back testing and optimize the value of N for some parameter on data set A and arrive at value of N, say N1. So this is what we call as data set A, and this is what we call as data set B. So what you need to do is you optimize your, say, moving average, and you come up with, say, that moving average 10 gives me best CAGR value. So once you have found out that moving average 10-day moving average gives you best CAGR value, you apply this and see how much the CAGR and the success ratios are well for this data set B. So once you have the idea that, okay, it is performing well for both of them, then you can say, yes, the optimization process is not an overfitting. It's just a genuine market parameter which gives you the whole idea where it should trade. So now backtest it on data set B with the value N1. If the result of the parameter is same as that of A, keep the value of N1, else try the next best. So if, say, 10 does not give you the desired value, so what you should be doing? You should be looking at the other next best value to N1, say 17, and then you again repeat the process till you get something which is being performing both in the back tested period as well as in the forward testing period. Okay, so Now you can ask me, well, I do it back testing, everything is done, but how will I analyze a strategy? So how I analyze a strategy is very simple. We have few parameters I have listed down. There are other lots of parameters that market practitioners do specify that gives a very good understanding of each and every strategy from various perspectives, but these are the few very common ones, and but they really do help you understand. So first thing is total returns. You have to look at, okay, how much return my strategy made over the period, and that is something like your CAGR. Okay, what is my cumulative growth rate? Then excuse me, then you can look for hit ratio. Hit ratio is nothing but how many positive trades, resulting trades you had in, say, a total number of trades. So we call it as a success ratio. So it gives you an idea about, if say you take a 10 trades and if your hit ratio is 50%, then 5 trades will be positive and the rest of the 5 trades will be negative. Then you have to look at average profit per trade. Okay, so that means how much money you make in a per trade profit. You calculate average loss per trade. That is, okay, how much money I'm losing on an average on a losing trade. Maximum drawdown. Maximum drawdown is nothing but you look at in terms of when your equity curve moves up, how much more money you lost. Suppose you start with 100 rupees and you keep on deploying your money, and your money increases this way. It goes up, and after some time it dips down, then it moves up. So if suppose it is something like 200 and it drops to something like 160, so here we have a drop of 20, which is equal to, sorry, 40, we have a drop of something like 20%. So we say that we have a drop down of 20%. And if we move ahead, you can say that again it might move down, then slightly up, but up. So what we try to see is the drop down from the top to the bottom, where this moves until unless this previous high is breached. So here this will be my drawdown. Say it is 250 and it drawdown to 100. So I say I lost 100 rupees over 250. So this is my drawdown. So you also have to look at drawdown, because if you are faced with a drawdown in your trading strategy, you will lose quite a bit of amount of money. Then how many maximum consecutive trades you lose? That means, okay, I'm using a trade, but it gives me a hit ratio of say 50%, but that does not stop the strategy to give you strings of losses, something like 8, 9, 10 losses. Are you comfortable with it? If you're not comfortable with it, then it will be very possible. It will be very difficult for you to trade after the string of losses, and you have to keep your emotionally balanced. So you should previously and have calculated before how many consecutive losses your strategy have shown in the past, and whether you will be able to check, and you will be check your emotions and you keep on working on the plan that you have designed for yourself. Volatility of the returns, that is how volatile is the return, whether you have something like a consistent return of 1.22% coming, or something like you make 10% one day, then you lose 3% the other day, then again you make a 5%, lose 2%. So it gives you a kind of a shocker. It means, oh my god, I've made, and they'll give you very high, sometimes very highs and sometimes very low. So it depends upon your temperament. That I'll discuss. So the third one is Sharpe ratio. That is where you look for your excess returns over the risk-free returns versus the volatility of returns. That is one ratio where you try to maximize the Sharpe ratio of your strategy, so that for every increase in the volatility of returns, you get some excess returns. That for every pain, you get some gain. So that comes to something which I call the choose what pain you can live with, rather than choosing what gain you can make. Means if I give you the ideas, look at it this way. You should know that what kind of risk you can take, because many strategies can make money. Similar kind of returns can be created by a plethora of studies, but it is up to you to choose what kind of pain you can bear with. Some person will say that, oh, I can take the strings of losses, but I need big trades. Fine. Somebody can say, no, I need to show my bosses that I am consistently performing. Then I need a strategy with a high hit ratio. So you have to work on that. What does suits your personality. And yes, then once you have done that, then you choose and work on that system. Returns versus risk, that will always come to you. High risk will always gives you that you have to take a high risk. You can go and do the low risk arbitrage, but it will again give you low returns. Or you can look for a high risk trending strategy, which will be something like requiring high level of patience also and gives you high returns, but is it your cup of tea? You have to decide. Then the hit ratio versus the average returns per trade. What I mean by average ratio of average returns per trade is, see, we always face a dilemma in the trading. You have either you can maximize your hit ratio or you can maximize your ratio of average profit per trade divided by average loss per trade. So what can happen is that either you will make few trades which have very good profits and small losses that eventually give you profitability, or it could be something like you make small profits, but you are also susceptible to the big losses. So in the small profits your hit ratio is high, but your average profit to average loss ratio is low. In other case where you have big home runs, your hit ratio is low, but your average profit to trade is very high. So it depends upon you what kind of trades you really want to make and what kind of pain you like to take. Can you take the pains of consecutive losses, or can you take the pain of one big loss but still wanted to make small money? A very good example could be something like, if many of you guys would have heard of Nassim Taleb. Nassim Taleb is a person who talked to you about the Black Swan event and how an unprecedented event can change the whole scenario. So if I look at his strategy, what he used to do, he used to keep buying the small out of the money options such that whenever there is a big movement, he will make a big money. So for him, say over the period of 2 years, maybe in a 1 month, he will get a big bumper returns where his deep out of the money options becomes in the money and he makes lots of money. But otherwise, in the remaining 23 months of the year, he lose money because your option will expire worthless. So for him, he can lose small money, but one day he will make big profit. For him, he follows this kind of a strategy. Another guy who can be something like an option writer, for him is like, no, I want some money from every month. So he can look forward to write the options every start of the month, and he will be like maybe write for majority of the month, but 1 month will come where he will make a huge loss. So he will be at the high hit ratio, but his profitability is low because he will be making say 100 rupees, but when he lose say 500 and 1000 rupees. So he has to manage that way. Okay, so that's how the hit ratio versus average returns per trade gives you that kind of a dilemma. Quick return versus maximum drawdown. Now, if you want quick returns, that means you have to play the big game. If you do want to play the big returns, big ones, then you have to leverage your positions. You say, okay, let me use a leverage of 5, let me use a leverage of 10, and how the leverage can change you and how can adversely and positively affect your returns, I'll just show you in a few minutes. So it's something like whether you wanted to make big money, so you have to face big downs, because when you are playing big game, then there will be big losses and there will be big gains. So are you ready for it? And it depends upon you. And susceptible, this will give you susceptibility to the big drawdowns. Okay, let's come to the sample strategy. A sample hypothesis that we would like to work here is, if the daily closing prices are above 60-day moving average, then we say it's a buy signal, and if it closes below, then we say it's a sell signal. Pretty simple strategy. I just wanted to take this strategy to show you the various parameters, how the parameters comes out and how you really decide upon the values and how should be the strategy be working. So that's the idea about it. So let's look at the parameters we tested for. We tested it for the daily Nifty data for 3 January 2000 to 31st December 2010. That's pretty around 11 years, and this had the almost all kind of market scenario where the market went into a bearish phase from 2000 to 2002, some kind of a consolidation in 2002 to 2004, then a bullish reason from 2004 to something like 2007. Then we have a brief period of what we call as distribution, and then again the market fell. So pretty much up and down, and it gives you the idea, okay, my strategy worked particular well in a bearish phase, but it does not well in a bullish phase, so I should be patient. So it gives you readiness whenever you are faced with a different kind of winds. Okay, so I did some back tested. I created some subjected these rules to the daily data and tried to come up with the returns. So the returns were something like I was making 279% returns overall period. If I just look at the annual returns, I divided it by 11, so it's like around 25% per year. Total number of positive trades was something like 33. Then total number of negative trades was 69. Hit ratio came out to be somewhere around 32. The average profitability, profitable trades was something like 12.8%. So an average loss making trade was minus 4.4%. So you can see out here that even if I'm just having something like 3.2 trades right in every 10 trade, but still I'm making money because for every positive trade I'm making three times as much as I lose normally in a negative trade. So average profit to average loss making is 2.94. So I do hit home runs where I make big money, but also there are small strings of losses where I lose money. So I have these 69 trades which are small trades, but a few big ones have given me this kind of a return. So is it that strategy for you? It's all up to you. Volatility of returns 11.4%. That is, it's also quite high, which gives me the sharp ratio of, if I take the risk-free returns of 10%, so something like about 1.1. Okay, now I would like to present you a few graphs, and then it gives you another kind of dilemma and another kind of decision making you have to do. So, and how you can decide upon it. Say, what I did is I looked at these returns. I tried to see that whatever returns I make, I start with 100 rupees. Whatever returns I make, I try to reinvest. If I say start with 100, I make 10%, so I have 110 rupees, which way I reinvest. If I suppose have 100 rupees and I lose 10%, so I have 90 rupees, so I reinvest 90 rupees, and so on and so forth. So I created an equity curve. So in the first curve, I just took a leverage of 1. So I said if I'm having 100 rupees with me, I take the position of 100 only. The maximum drawdown I am facing is around minus 21%. And by the end of, say, December 31st, my 100 rupees have turned into something like 1,000 rupees. Whereas if I have taken equity curve of 2, leverage 2, that is, I'm having a money 100 and I'm taking a position of 200, then my maximum drawdown goes to minus 38%. However, my money also comes out to be something like 4,500. With a leverage of 3, again my returns becomes exponentially high. I get something around 14,000 on I make some 14,000 for 100 rupees. I'm not taking it any taxes here, just for the information. So 100 rupees have turned into 14,000 rupees, and meanwhile there were times when I have to handle the drawdowns of minus 55%. With the equal leverage of 4, I think this is in this print. So with the equity leverage of 4% here, your returns move on to something like whopping 100 rupees turning into something like 28,000 rupees, with a drawdown periods of something like you are wiping out minus 64%. So you can see that in a fourth case where we am having a leverage of 4, your 100 has returned into multiple times, but yes, there are times where you would have seen your 4,000 rupees, 40,000 rupees have just came down to 15,000 rupees, and that could be a devastating for any fund manager, because if suppose he is in the starting of the year and he sees his portfolio just dwindling like this, then it creates a problem, because investor like to see each and every years of return, not just the whole gamut or total 5 years, 10 years return. So it is all up to you how to decide. So the question comes, why you want to trade? You have to decide whether you want to really prove yourself right or you wanted to make money. Getting the right tools and the skill set is the most important when you are deciding upon to the trade, and because that will give you the real idea about what to trade and what not to trade, how to trade and everything. Because without right tools, this is a very competitive business, I can tell you, and there are so many other people who are there. So without right tools, it will be very difficult for you to see through the market and decide upon whether you should trade or not. But one thing which is above all is one mantra and only key to success is improve every day. Maintain journals, see what made your trades wrong. Look at what are the different conditions where you get in the market stuck, and once you know that, you keep on improving and improving, and you will find some kind of a daily practice where it gives you the yes, this is the right methodology for me. So once you start looking out for the reasons, then you will find out that using stats you can find out, okay, these are the market conditions where you are getting stuck, and slowly and steadily you will improve. Diligently improve on your mistake, commit new ones and improve on them. And that's how only any big trader, just read the biographies of Warren Buffett, or you try to read Ray Dalio, he always says the same thing, that's improve. Any big hedge funds, any big algo traders, you will find that he's doing that. Okay, so that's about how you do the back testing, how you do about analyzing your equity curves, how you analyze the parameters. So let me now give you some idea about the course, basically EPAT course, where this all things fits in, because as you know, these are just the part of the whole process I just explained to you in the start of it. Let me just come back to the slide, this slide, where I just gave you some idea about the hypothesis formulation and the back testing and optimization. In itself, these two sessions are big sessions. How you do it using Excel in R, how you optimize, what are the values, how you check it out. So there are various much more depth we go into, but even apart from two, we have four, five sections which any algorithmic trading has to go through. So let me give you an idea how this EPAT course gives you the whole perspective of everything. So we have divided our course into three broader categories, as we say: statistics and econometrics, financial computing, and algorithmic and quantitative trading. So when we teach you stats and econometrics, we give you the idea about probability and distribution, statistical inferences, linear regression. Then we move on to the advanced, like correlation versus co-integration. So this gives you an idea about whether you should be using the co-integration or correlation while doing a mean reversion, ARIMA, ARCH model for your volatility and for trend market. So it gives you, okay, if I am looking at for it as a trending market, how it should be look like. Then we do the multiple regression, when you have lots of parameters, you have to check which one parameters is affecting the other parameters in which form. That way you keep on doing your advanced stats. Then we do the time series analysis, where we are giving you about what is a stochastic maths. Then you look for causality. Causality would be something like, okay, this event is affecting this series affecting is this, there is this much of difference of the time, how you should harness it. So all these kind of basic understanding of the market. So these are all just lenses, and we try to provide you with these lenses so that you get the idea and a hold of how the market works. The last is forecasting. Once you have some idea about, okay, this is the way the market is working, you try to create your own forecast or your predictions, and based on that predictions you try to get and see, do some trade and try to get the values. Then we take you through the financial computing and technology, where the programming forms an essential part, because you have to go and test your ideas. Unless you test your ideas, it becomes very difficult to prove. So we give you introduction to the programming languages. We'll give you introduction to the Java, which will help you out in your coding. Programming on algorithmic trading platform will be done, etc., which we will be giving you the idea. and you will be trading yourself. You will be sending orders to simulators and seeing how your idea gets implemented in the real terms when you are working with any algorithmic trading platform. Then it will help you out in the linear regression. Technology for the algorithmic trading. This is a kind of architecture. Means I said to you, okay, this is algorithmic trading, but what it is actually? It is a full architecture. You take the order, you convert it into the message. That message goes down to the exchange. Exchange will recognize it, puts it in its books, and then it will have some execution or some kind of information. Then it will send you back, okay, we have acknowledged, and then how you behave. So this is all an integrate process, a small easy process, but it just need a process understanding and understanding of how the things work. So we teach you all these things in system architecture, understanding algorithmic trading platform. So how your platform handles everything. What are the things your platform should handle? That is all things we talk to you about in this part, where you have so much of data, so less of data, how you really work about it. Then we talk to you about how you handle the HFT data. So when you are working with the high frequency data, you are faced with a lots and lots of data. Oh my goodness, if I look at the data, you will just get bogged down, but how you handle it. So we give you tool about it, we give you various tools, we give you various algorithms, we talked about you how you really handle them. And then we also teach you the statistical tools. Excel, we start with Excel. We'll give you how you work in Excel. You should make a small model. Then we take you how to create any backtesting model. The one just I created for you was just created in Excel, and then I just took this series 60 days in my Excel, and then I put up the data points and I got these returns. So how you get these returns, how you really create quick what I would say, quick results, quick parameters, and you keep tweaking your parameters and getting results quickly so that you can analyze and come to the execution part. So that is what we teach you in Excel and VBA. Financial modeling with R. So R is an open source system where you get to code various sophisticated processes like ARIMA, GARS, co-integration very easily. So we teach you that. We make you apt in it so that you can do your calculations there and arrive at the models as fast as possible. So we also teach you how to do R in for the backtesting. And the third part is algorithmic and quantitative trading. So you will say that, okay, you gave me hypothesis, you gave me tools, but will you give me some strategies? Of course, we'll teach you some strategies. Otherwise, why we are here? So we teach you strategies to make statistical arbitrage. I hope you must have been aware with the pair trading strategy, which is one of the most researched and most traded strategy in the worldwide, because it gives you some kind of uncorrelated returns if implemented well. So we teach you how to implement a statistical arbitrage strategy. We teach you about market making strategy, which I explained to you in the first half of this webinar. We teach you various execution strategies like VWAP, TWAP, how you really create them. Forecasting and AI-based strategy, that is a very niche area where you use the computing powers and try to find out the patterns in the market, and based on that patterns you go and trade in the market. We teach you about machine readable news, how you really read the news from the using machines, and how you would be fast enough to go and trade in the market. And of course, the trend following strategies, we'll take up 2 to 3 trend following strategies and we'll just tear them threadbare and see what lies in their heart and how you can make your own strategy, how you can make your own indicators and trying to find out how the market work. Apart from it, you work on the option pricing models, various options, time structure of volatility, it gives you how the volatility work. We teach about dispersion trading. We talk you about volatility forecasting using an interpretation using GARS. Then when you are managing the portfolio of option, you have to look at the managing risk using Greeks. So which Greeks moves where, how you manage all these Greeks we talk to you about it. Position analysis, order book dynamics, where we give you, okay, the order book is changing this way, how you should behave, what are the various formats and order book move from one state to other state. So what you should be doing. So we talk about that. We talk about the market microstructure, how the things work at the molecular level. What I mean by molecular level is molecular level of the trading, and the molecular level of trading is your order book, how the order book changes, and as the order book changes, the whole organism, which is a market, changes. And we talk to you about managing various algorithmic operations. So this is something which you might say, okay, this is not that technical, but believe me, this is something where the real crux lies. If you know this right, many of your success of your operations of algo trading will depend upon it. So hardware and network is very important. Regulatory framework, where frameworks do keep changing. There is something like a new tax being added and everything goes for a toss. You have to realign your models. So it's very important to be abreast with all these things, and that's why we always put a very special emphasis on understanding the regulatory framework, and that is how you really understanding of the regulatory framework leads you to the success in the algorithmic trading. Exchange infrastructure and financial planning, how you should be planning your system. You might plan a lot of money, put it up, but you see, oh, no returns are coming. Then it's really a very essential. Handling risk management and automated system. Now, that's very important. Means what I call automatic trading systems are like, they are like AK-47 machines, guns. Like they just throw orders in the market, and if they are not very well handled, it creates lots of problem for the traders. So we need a proper risk management so that not a single order goes out of the way which we want it to be. So that's about the broader EPAT course. Just give you the idea about the operational part. It's a weekend only program because we know that many of you guys are working professionals and it becomes very difficult for you to attend it during the weekdays. In fact, our faculties are also working at different places, and they too are practitioners from the algorithmic trading, so they do take some time out and give we have sessions on Saturdays and Sundays, both 3 hours. It's a 4-month-long program. Excuse me. It's a practical rated oriented program. Every class, either it will be followed by some kind of an assignment, or you will be asked to do hands-on in the class, so that you really get to do work, because it's something like a work-oriented, if I call it out, course, where you have to work, more you learn. It's 100 contact hours, including the practical sessions. It's a pretty very stuffed program. And I can assure you, once you work on through it, you will really come out to be as a very good quantitative and algorithmic trader. Convenience, so we can always conduct it through online if you are not able to make a presence in our classroom, so that gives you added advantage. But softwares we use, we use R, that is open software, mainly for your calculation perspective, advanced statistical perspective. We use MarketStrater, that is also an open source software for your trading platforms, and we use Excel, and I assume that Excel everybody has at his own PC, so that's also more or less an open source. So virtual classroom integration, that you will feel like that you are just sitting in the classroom. And we do have a students portal where you can just put your doubts, you get your assignments there, you can upload your assignments, and these all things are done to facilitate your learning as smoothly as possible. Beyond this, your faculty is always there for you. You can shoot your questions to them, you can ask them where you are getting stuck. Apart from this, our institute provide you placement assistance. We help you not only just your resumes and how to prepare for interview, we also try to get your contacts through various industry partners and through various industry members, and try to get you interviews and placement. We provide you the placement assistant regarding that. Okay, that's about the QuantInsti course EPAT. Let me also give you some important dates. That's 5th December 2013. So it's early bird registration online, where you can avail the discount. I think it's if you are still in the fence, you can jump onto this now and you can register for this course. You can believe me, this course will gonna change the way you look at the market. Means what I say is that unless you look at the market from a different angle, you won't be a good trader. So you have to look at from various different angles, and it will really gonna help you in your career. And of course, batch will start from 4 January 2014. The class starts then, both online and offline. You can visit our websites and the scholarships. The links are given below. Okay guys, so that's from my side, and I would feel that I hope you my guys might be having lots of questions, so you can just start asking me questions and I'll try to take up one by one. Okay guys, you can start asking questions, and if you have any doubts, let me answer you as along. Okay, so there is a question from Mr. Desai. Your observation of overfitting is agreeable, but what about clustering of profit or loss-making trades? Usually it is always a fallout when using a moving average based system. Yes, Dharya Desai, I totally agree with you that there will be some good trades, lots string of profits and string of loss making trades. But there is a difference between overfitting. The overfitting, what I meant was that you use a particular parameter which work only during that time. So an overfitting criteria can be overcome by the forward testing which I described in the in the slide, that you divide your trades between, say, if you have 1,000 trades, divided between 800 trade and 200 trades, and based upon that you really find out what is my best way. I hope this gives you the answer. There's a difference between overfitting as well as the clustering. Clustering is a bit different. You can have the lots of profit trades. Suppose your strategy is more suited toward buy trades, and there are lots of market is moving in a buy phase, so you will have lots of profit kind of scenarios. Okay, Rahul Deshpande has a question. Please give an example how the statistics can help formulate hypothesis. Okay, Rahul, one of the the stats is like we take a pair ratios of, say, TCS and Infosys, we subject it to co-integration, and if we find that this pair ratio is co-integrated, then we can say and co-integration perhaps is a very beautiful statistical concept, and once you know that these two pairs are co-integrated, so you can apply the mean reversion theorem that whenever the pair trades move away, pair moves away from its mean, then you can go and trade. So that's how we really use the statistics by formulating of the formulating the hypothesis. Okay, Rahul, you had a question why the model maze using the quantitative method can can perform better than those by technical analysis. I'm not saying that any method which is being made through quantitative method is better than technical. No. What all I'm saying is, even if you are doing a technical analysis, see, the technical analysis is nothing but you use some MAs, you use some RSI, or you use some parameters. What all I say is try and create it in a code. Try to formulate all these things in a numbers and subject those numbers to the rigor of quantitative method. A quantitative method will give you some kind of trading signals, fine, but once you subject the quantitative methods based trading strategies and the technical trading strategies, you should always be doing it with the same mathematical rigor. A mathematical rigor is they should have good hit ratios, they should have good average profit and returns, and all these kind of system, all these kind of parameters you should subject it. Many times I met many technical traders, they say that yes, this perform this way. Okay, I say fine, let's code it, because if you code it, it gives you the ability to go not just trade on, say, Nifty or Axis or ICICI Bank, which you might be doing in your daily ways, but you can trade hundreds of stocks, and that gives you hundreds of more opportunities, provided you statistically prove that yes, this trading pattern is unique, and whenever it happens, it gives me these kinds of returns. So you always have to back it by the quantitative method. Nothing depends upon whether the strategy developed from the quantitative perspective or a technical perspective is superior. Okay, I have a question from Kunal. Is it possible to improve the hit ratio as well as the average profit to average ratio simultaneously? Now, Kunal, that is a really the trade-off. Means in the previous strategy, I showed you that we are having a just hit ratio of 32%, whereas the average profit to average loss, we were 4%. So yes, you can increase it to somewhere like for 40-50%, but yes, you have to pay more on the you will be on the more on the losing side. So the more you increase your what I would say hit ratio, the average profit or loss goes down. But yes, you can, once you study the market through stats and when you study it through various angles, you might come up with a hypothesis which can balance it out. So on the normal strategies which are available in the market, you always find these kind of trade-off, is whether your hypothesis is good enough. Once your hypothesis is good enough, you can do this kind of what I would say improvement in the hit ratio versus the average profit trading, average profit to loss ratio stuff, but yes, to a certain extent only. And that is something the part and parcel of. If I say that yes, okay, we can help you do this and that, sorry, nobody can help you do that. That not much of it is possible unless you have some very distinct advantage. But in a normal in the normal trading scenario, this is the trade-off which everyone faces. It's like this: you want a good muscular body, then you have to go and work out in a gym. There is no substitute. You have to do it. So it's like pain. That's why I say, what pain you like to take? Whether you like to take a pain of hit ratio or whether you like to take the pain of the average loss. That's how it really works. Okay, Rahul, I just gave you the example of how the statistic help in formulating the hypothesis. Then Venkat Subramaniam has a question. If you miss a class due to work compulsion, would the video of the class be available for the access in archive? Yes, Venkat, sure. We do have the videos available to you where you will have the full follow-up how the class had worked, and of course you can also put up your doubts in a mail once if you have missed the class, so it's not a problem. And it's my bad that I didn't mention it out in the about the course that we do keep recorded our videos. We do send you timely what are the PPTs and what are the Excels or what are the different programs which have worked out. So if you miss some class, you can always cover it up in the videos. But having said that, there are some classes where you need to be here in the class where you or in the class or at your system where the instructor will walk you through each and every step. For those classes, I think it is much better that you should not try and miss those one, because these were the classes where you walk through everyone's. So yes, we do have all the videos and which will give you the whole understanding of the particular part created. Yes, we know we do give some idea of the Monte Carlo method, but it's again the kind of excuse me, feed forward testing method where how you really try to generate various scenario. So if I say we give you idea about Monte Carlo method, but we delve into various other methods which gives you the whole perspective of how you forward test, how you look at the various conditions, how you look at the market and try to get the best benefit of the back testing versus the forward testing. Another question from Kunal Shah: by using advanced statistical techniques. Okay, the advanced statistical techniques we mean you like ARIMA, GASH, and various co-integration, and there are various other parameters. Once you will be having, you can have the whole parameters are people will help you out in doing what all the other different advanced tools we use, but these are the various just a few names: Arima, Kash, Arch, and what the various different derivatives of these. We help you understand, and we tell you how to use them and why to use them. Basically, the best thing is you should know why you are using them rather than just how to use them, and that is what we try to give you an understanding for it. Thank you, Mr. Desai. Will the course focus only on HFT or LFT? Hi Hosh, it will focus on both. It not just on HFT. We will first start with few LFT low frequency strategies, and then we give you a paradigm, and slowly and steadily we'll build you up how HFT strategies are created. So the idea is you should have the perspective in what is strategy formulation. Like today's lecture was more of how you really form a strategy. It's nothing about HFT or LFT or anything. These are just the how fast you execute. So our idea is first to give you how the strategies formulate, and slowly and steadily will take you through HFT and how the HFT strategies are formulated. I hope that answers your question. Sir, do we analyze failed trades, or is there a backtesting for failed trades? Please enlighten Mr. Ravinda. Oh yes, we do analyze it. I think that is the best thing that you can do when you are doing in your trade. Unless you analyze your failed trades, how will you know that where you are lacking? See, whenever you have a bad trade, there could be either two conditions. Either one condition could be like that your hypothesis is still not complete, or it requires some more of the tweaking, some more of understanding, and that you can avoid by slight change in your hypothesis. You can avoid so-called failed trades. The second condition would be something like that. Even if your hypothesis is right, you know that it's a failed trade, but it is failed because it's part and parcel of the system. It's a part and parcel of the market. So if you can decide upon whether it is a condition 1 or 2, and if it is condition 1 where your hypothesis need reworking, then it really gives you good boost in understanding your system and understanding how you move it. Hi Vivek, Vivek Khurana has a question. Number of trades that you were referring to, 100,000, should be spread over what time frame? Good question. See Vivek, what I was talking to you about is not just the number of trades. I was talking about the different phases of the market. So these 100 or 1,000 trades should at least span around various scenarios of the market: bullish, bearish, consolidation, and distribution. All these phases you should have some good amount of trades, so that you know, okay, you have a strategy which is a very good trend following strategy. You will see that these strategies perform very pathetically during the time of distribution, where the market is topping out or where the market is bottoming out in a consolidation phase. So unless you have these two phases included in your system, how will you really know that your system has properly been tested or not? So you need at least, not 100 is just one number, but you need 100 should be there even if you have gone through all the 4 phases. But these 4 phases are something which is very essential to see. And what I always believe is you should also have some time where we had some kind of a circuit scenario. Like many a times in the, say not now, but in 2007, 2008, we had quite a few times where the market hit a down circuit as it opened up. So you really need to have those kind of phases too included in your back testing. Could you please let me know of some open source algo trading platform? Yes, we know you can try it out something on the market etc., which we also deal with in our course, which we take you through how you really do about it. It really requires understanding, and you can use that one for the algo trading perspective. Market etc. is the name of the platform. Rahul has another question. Is quantitative trading feasible for the retail trader in the light of capital requirement for strategy approval of requirement? See Rahul, there are two things. There are two things like you are saying quantitative trading, yes, it is feasible for the retail trader. You can always do it. For the algo trading, it requires certain more criteria for the retail trader to do it. But quantitative trading, in terms of where you generate your signal based on purely quantitative methodology, you can always do as a retail trader. So that does not require much of a problem. See, you decide upon some trades and you can say, okay, I buy one lot of Nifty here and there or I sell. So based on that way, you might not be requiring much of a capital and still you can do it. But yes, algo trading, it requires bit more intricate legal requirements for a retail trader. Okay, Navratan, thanks to have you with us. Hi, Venkat has another question. Is it possible for algo software to misinterpret indicator signal due to high frequency traders sending large number of orders or false uh, trades leading to loss or algo traders? How can we protect against such HFTs? See, Venkat, whenever you are having a data, you can always, suppose there is some spurious data which comes because of some kind of a market action. So you can always have some kind of risk, some kind of checks and balances while calculating your indicator signals that, okay, if the, suppose I'm trading at 6,000 Nifty and there is some signal which says that Nifty is traded at 6,500. Of course, you know that Nifty is trading at 6,000 and any other signal 6,500 will give you spurious data. So what you can always say that all those data points which are particular band are only the right signals, and if there is some signal which is beyond appears to be not normal, the best strategy I would say that you stop, you check, you stop quoting in the market, you just stop and see, okay, whether this is fine or not. If it is fine, then you can remove the data point and see that it's just some kind of a noise. Or if it is not a noise, then you should really see that something has happened. And if that something like this happened, you can remove it out. Secondly, it depends upon what kind of a strategy you are using. You say that how you can protect HFT. Suppose you are dealing with HFT and you are trading in HFT fashion, that you are changing your orders at every bit and ask. Then whatever, if there's a large false order, you have to take care of it, and there are methods through which you can take care of some false orders. You should know whether it's a false order, whether it's a false book which is being created. So if you are trading HFT, there are methods which give you an idea about how you can handle those false orders. And if you are trading low frequency trades, then as I told you that you should be looking forward to change your indicators as and when required. Means you should stop it if there is some kind of a spurious data that comes into the market. Okay, there is a question from Vinod. What level of maths background do assume for the course? See, Vinod, if I ask you the maths course, you should know have some basic understanding of maths. You should have understanding of calculation of how you calculate returns, how can you calculate profits. You have some idea of, okay, what is standard deviation. If you don't know, that is fine, but you at least know how to do well calculation in terms of calculating if you buy a share at particular price and sell at a price. I can tell you there were students who came here who do not knew how to do the calculation of buy and sell, and we worked with them. Once they move ahead, they knew, okay, what is buy and sell, and by the end of the course, the student was calculating and doing the execution strategy VBAP, which is a very integrate strategy himself. So I mean, if I say, if you ask me that can I do, I cannot try, I can, should I or shouldn't I, then I say no. If you know the mathematics, if you're ready to learn, what is required is two main things that is required from you is that you are ready to learn and you are ready to do the hard work. Faculty will give you lots of coursework, lots of assignments. If you really do it well, I am assure you will learn all the mathematics, all these concepts very well. It's just that we try to teach you through first intuitive. Once you know it intuitive way, then we give you, okay, now you know that this is happening, now you put it in the language. And mathematics is a language to communicate with your softwares and computers. So if you know basic mathematics, it's good. Would be teaching how to forecast volatility using Garch and various approach? Yes, Parasha, we will be having this part of in the course, where you will be doing extensively on the GARCH and various form of GARCH and how you really forecast your volatilities based on that. So we have devoted a good amount of time on the advanced stats courses. Navratan Bora has left, but his question was, do the course require basic knowledge of language? If you have some basic knowledge of programming, that helps, but we take you through one programming language, that's Java. We start from very basic. We teach you how to do it. I also give you, I myself take some classes on VBAs and associates takes on VBAs. We teach you through how to do VBA. We first give you what is a paradigm in programming, and once you know that this is the paradigm in programming language, then all you need is to just to know the what I would say syntax. So it's just that you know how to formulate thoughts, whether you speak in Hindi or whether you speak in English or you speak in Marathi, then you try and communicate each and every method. So once you try to do is how to create and think logically, that what we try to teach you in programming languages. So that's it. Yes, we know that it is called market, etc. Okay, Vivek, we welcome you back. If you have any questions, do let me know. We know, yes, quote stuffing, see, there is nothing like illegal. Nobody can go, there will be people who might be doing it. I do not have it in my knowledge, but nobody will allow you to quote stuff it. So yes, there will be people who will be trying to do the quote stuffing, and what I can say about it, it's not legal, but some people, because there might be some lacuna in the implementation of the legal system, that they try and do that. So it's, if I say it's no, it's not illegal. Thank you, Venkat. Thank you to be patiently listening to the presentation. I hope if you have any other questions, you can drop into us. We are always available to you, and you can always have more information of anything. Please keep in touch. Hi, Rahul. So CQF is a course where we mainly deal with the idea of quantitative trading perspective, where we go more into detail about what are the various statistical methods for the various kind of scenarios, various kind of risk management. However, the EPAT course, see, the CQF is more also determined on the more facet of analysis of any system through the quantitative finance. But EPAT course is something which is very directly pinpointedly geared toward your trading. So I can teach you Excel in a very 100 format, but when we teach you Excel, it is only pinpointed for doing the trading, back testing. We talk you about in that perspective. If I teach you R, I'll teach you all those methods will help you understand to create signals. Our whole objective would be how you can create signals, how you can create the trading strategies, how you can create the trading models. However, CQF is something like it will give you whole perspective of how you really understand the system. So it's just the understanding. It's more of, if I say yes, the CQF help you more on the side of the hypothesis formulation, while EPAT is a comprehensive course which not only talks about the hypothesis formulation, but it also goes into the full value of it. I hope this gives you the answer. Okay, Kunal, thanks. I think he's left, Kunal. Any chances of taking CQF plus select modules from EPAT that are more practical? I think that's not feasible, because I can give you the answer. See, if you say that some practical, because all lectures are very much interlinked, means when we are teaching you the advanced stats, we see to that you have gone through the learnings of basic stats, and then only will work on the advanced stat. And once you have gone to the advanced stat, we have lectures on pair trading, where, because there are the learning which is more on, if you say, the practical side, there are something which are learning which are very much required from the advanced stat. And suppose you are doing a programming lecture or a market sector lecture, those lectures are really something requires you that you first have gone through some kind of a Java, some kind of a prerequisite. So it's a full chain. If you say that, many people would have asked me even in the past that, hey, can you take these part as a separate module? Means I tried it out, but we didn't find it out very useful because everything is linked. See, I showed you 5-level charts where you have hypothesis formulation in the last coding. If you break one part, what's the crux, the whole meat in the system has gone. So that's why it's very difficult for you to just take a select EPAT. I'm sorry, it's not very feasible. Okay. I hope Vinod I answered your question. Okay, Rahul, thanks for attending it. I hope there is not any more questions from our esteemed guest. So just few more minutes. Thank you, Vinod. I think we do not have any more questions, so let's call it a day for this webinar. Thank you, everyone, for attending the webinar. I hope it added value. I hope you would have taken some ideas about your backtesting and more so about your trading understanding, how you really want to trade and why you really want to trade. Make your mind why you really want to trade, and then you will get a right tool. I'm sure if you really decide upon when you really want to trade, take the right tools. Without the right tools, it's very difficult. Yes, Vinod, you can go ahead. So without the right tools, it really becomes difficult to succeed. Means you need the best weapons. It's always the race of weapons now, not just the skills. Have the best weapon, have the best skills, and go and fight. Yes, Vinod. Yes, Vinod. Some people are using it. I do not know particularly name, but when we are teaching you market cetera out here, we really take you through the whole process of how you do the strategy code and how you really send order to the simulator, and it gives you the full idea about how you really do it. If you ask me the names, sorry, it's difficult for me to get the names, but I know that is it. Oh my goodness. So if you are saying the ROE for expected for, sorry, Ghosh, it's very difficult for me to give you this answer right now because see, there is nothing like a benchmark that, okay, you have this drawdown and this ballpark figure. It depends upon hypothesis to hypothesis. Some hypotheses are quite good enough that you can get a returns, means there are people who have generated returns of 20-30% annually with a just drawdown of 10%. So some strategy might give you just 15% return in ROI, the drawdown of 10%. Some strategy can even give you the 20-25% returns with 10% drawdown. So it all depends upon how you formulate your. See, it's like drawdown. If it is 10% or 15%, it all depends upon how you really take it, and that is more important. Are you comfortable or not? So I can't give you any just ballpark figure, but there are people who have given very less drawdown like this and generated 25-30% return. So they have their hypothesis formulated that way on a consistent basis. Vinod, I have not worked on Symphony, but Nest is something which is very basic. I have not, again, say, and I've seen only Nest, which is not one geared toward the algorithmic trading. So we try to give, these are the good ones, but they are not a full-fledged trading systems. For a particular full-fledged trading system, I mean, they are not very well suited for high frequency. For the high frequency, you need to have a very good execution capabilities. You should have the latencies and mu seconds and something like that, so that you really get to do the best. And you really see, it's like a strategy. A HFT is something like if you are the best, you get the whole meat. So you have to be good in the market. That's why I've not have the idea, but I've not heard their exceptional performance by them. So no DMA is equal to HFT fail. I couldn't get you. What does this mean? I couldn't get your meaning of this question. Can you elaborate it? Yeah, means right. You need a DMA. Means what is DMA? DMA is nothing but what used to happen is that whenever, let me give you some idea about the DMA, then you will get the whole picture clearly. What is DMA? DMA is I'm an institutional broker. I'm an institutional client. Say I'm a hedge fund or I'm a mutual fund. Whenever I used to trade with my broker, I used to call him up, place my order. Then this broker, we used to execute these order into the market. Now with the DMA, what it does, it gives you direct market access. What is a direct market access? This guy, broker, this guy hedge fund will have a terminal with him where he will just punch in an order and it will directly go into the exchange. So that is called DMA. So if you do not have that direct market access, you will obviously not able to do the HFT. So that's what that's answers your question. Okay guys, thanks for attending this webinar. Have a nice day.